Hi, Joe.
Hello. Hello.
Hi, everybody.
Hello.
Hi there.
Okay, I'm unmuted. If you're going to speak, if you use the microphone and turn it on, and then when you pass it, turn it back off. It helps the Zoom people to hear. And likewise, that's why the speakers are here to help you hear the Zoom people. Right now, Dwayne Madden from Capital City and Cassandra Harvey from Klausner are both coming in via Zoom.
Let's go ahead and call this meeting to order. This is our City of Palatka Police Officers Retirement Plan meeting for December 15, 2020. Roll call, please.
Greg Cummings,
Present.
Carol Hill,
Here.
Scott Mass,
Here.
Toby Williams,
Here.
all present.
Thank you. Next up is approval of minutes. Does everyone have an opportunity to review minutes? Okay, a motion.
So I'll make a motion to approve the minutes from the September 15th. I second.
Second, Officer Mass. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. Moving on to Sawgrass report. Greg.
Everyone has their mask on. So, have a wet word that comes across the room to you. Well, good afternoon. For the record, my name is Greg Gosh, and this is the first time I've ever held a microphone with a mask on. So very uncomfortable for me, but thank you for having us. We have now been working with you 18 years. I'm in my 14th year with Sawgrass, and we appreciate your business and your trust and your confidence. And if you'll turn with me to page 10, I've got two things to cover today. First of all, I'm going to be quick and just cover Sawgrass. There's been no changes in the firm. We have over 70 clients in the state of Florida, including yourself. We're right up the street in Jacksonville, and we take our Florida clients a little more. They feel more like family because we're right up the road. But we're in 26 states, and we have continued to grow and be in a holding pattern throughout this pandemic that we've been dealing with. But as you can see on page 10, for the past year, pretty significant change in your portfolio. Start of the year, 9/30 of 19, looking back 12 months for your fiscal year, 2.6. Added just under 550 in cash, gains of 214 for fixed income. That's very good. Finishing the year at $3.371 million. Then on page 11, and this is where I'm going to kind of finish up on performance and then go into subject matter number 2. For the quarter, strong quarter for fixed income, up 1%. Your index was up 60. Your 1 year, 8%, a very strong year. And your 3 and your 5 are in the 6 and 5% range, which is where you want to be for fixed income. So we're going to talk about Leardon is going to talk about how we were able to achieve these numbers for you, where he sees the fixed income market going moving forward, and answer any questions you may have. So with that, I know I said I was going to put this thing on, but I'm like tasting my own carbon dioxide as I'm trying to talk to you. So I'm going to just talk in this direction. But so we have developed, so we've been working with you for 18 years. We have now come up with a product that it's similar to a mutual fund. It's called a CIT. And it is where it's the advantage for you is it will take your fee down from 40 basis points to 29 basis points. Instead of housing anywhere from 40 to 60 different line items with your custodial bank, you're going to have one. It is more liquid. It's something that you can sell when you need to raise cash. You can do it probably by the next day or the day after instead of T plus 3 or 4. So it's something that we've got out there, and we think it's easier for us to operate in the world, and it's also advantageous because it makes you more liquid. It's cheaper, less expensive, and you're more liquid. So what we're proposing is there's no change in your investments. And Leardon, you want to comment on that at all about?
Yes, so it will be the same strategy, the same line item, the exact same line items as you own right now, but it will be wrapped under this vehicle called the Collective Investment Trust, which you will be a member of this trust. So anytime you have a cash call or if you're doing any kind of rebalancing, theoretically it should be much cheaper, much more efficient for you, because instead of selling a bunch of line items that you would per rata sell, in this case you just sell a much smaller fraction because you would be part of a much bigger fund. So you would get the same strategy, same returns. Net of fees, they would actually be better returns because, as Greg mentioned, you would save, just to start with, you would save 11 basis points. But anytime you have any kind of cash transactions, whether you're rebalancing or you're adding or you're decreasing the exposure, that would enable you to do it in a much more efficient way.
So we've already talked about this with Burgess, with your attorney, and with Capital Cities, your custodial bank. So everyone understands it. We can do it. It's something we would like to propose to you and see if you, and the fire just agreed to do it. So with that, it's something I wanted, before you got to listen to Learden, wanted to have you guys talk about and see what you thought.
Do we need to change anything as far as the policy is concerned?
I don't believe so.
So we have recommended using the collective investment trust in other cases. It simplifies the process. It makes it easier for them to raise money when Dwayne needs money to buy equities, or if he's going to take a small, let's say $200,000 piece and dump it into the bond portfolio. It's easier just to dump it into the fund than to have to. How many have 60 holdings?
On average, you would have anywhere from 50 to 60. So when you have this separately managed version, it's a little bit more cumbersome.
It's still custody at the bank, so they're still watching it, and your fee structure goes out from 40 basis points to 28 basis points.
It would be from 40 to 29 basis points.
40 to
11
29.
basis point savings.
So that's roughly a 25% decrease. So lower fees, no change in performance, actually better if you net out fee differential. And everything's still custody at the bank, and it doesn't pose any challenge for Dwayne, your manager. So on that basis, I'd recommend that you do it.
Any other questions?
Are there any negative setbacks?
What was that question?
Is there anything negative to it?
Anything negative? I really think it's the wave of the future. And it's I think it's all net positive. I don't see anything negative. There's transparency. Does it get audited?
The manager of the trust, which is Alta Trust, which we partner with, they provide the audit and all the
It's
services.
just having an audit done, so I don't see any downside.
Yeah, so part of that 29 basis points, some of that goes towards the audit fees and all the legal fees that manage the trust.
So with this trust, is there other agencies, businesses in this group with us now, or is this still just?
You're just getting a Sawgrass product. The platform is in the, you want to answer that question? The platform is managed by Alta Trust, and that's all they do.
Yeah.
Is they run mutual funds and CITs like this. So basically what they do is their job is to go every day and give it an NAV, basically, what's the cost for each share, like you would a mutual fund, and then calculate that. So like, let's say, during the day in the market, it went up 0.001%. They have to actually put that marker down at the end of the day. So if we get a call that night, hey, first thing in the morning, we need to sell this amount, or we're going to add some cash, we know what we're buying in at for the fee.
There's some infrastructure costs that are pretty steep, and that's why they partnered up with somebody. That's logical to do that. If they had 30 million in this product, they wouldn't partner with anybody. They do it themselves.
Someday.
Yeah, it's really the same exact strategy as we have right now, as you see on the presentations, but it would be wrapped under the CIT umbrella. So you would see one line item as opposed to seeing all your 60 securities.
But you can still see all 60.
You can still see, so if you drill into the prospectus and the fact sheet of the fund, of the trust, you would see that same exact line of securities.
But if you're Dwayne's people and they need to either liquidate or they're giving us money and we need to keep the portfolio from dispersing out where it's not even what it used to be, You don't have to go out and buy all the different stocks. You're buying shares right back into it, and then everything trickles into it from there. It simplifies
It's
things.
more efficient, when you have cash movements, from a transaction cost standpoint.
So if Dwayne wants to do an overload in one of the areas, is that now possible, or does it just rebalance to the standard set of percentages that we've outlined up front?
It's all the same. It's actually easier now, because now he just pushes one button, and then that button alerts them to raise money or take their income. Well, it actually all occurs at the bank, because the bank can do an intra-account transfer. Let's say there's 300,000 raised from Dwayne's side. He just dumps it right into this account at the bank. Where in the past, the cash would be raised, it would go into the Sawgrass account, and it may sit there for a week, because he's fishing and not paying any, I'm just kidding. But it goes in there right away, and this the firm they're partnered up with knows the next morning to put the money to work the next day. So it's a much better arrangement for you.
Like to hear from Dwayne if he sees any.
Dwayne, do you have any thoughts?
We're in the process of setting it up. We have not gotten approval yet, but I anticipate we'll get approval to do it. But just letting you know, we've not received approval yet from our custodian.
Okay. Anything else? All right. You got anything else, Greg?
No, if you guys would like to vote on that now.
So, I guess the first thing I'm gonna do is what's the pleasure of our board as it relates to the recommendations that have come forward from Sawgrass on this matter to move forward? And if you're open to it, then you can do it subject to approval. And that way we're fine. So we can move to do it subject to approval on Dwayne's side. So with that being said, I entertain a motion.
So would that be to enter into the collective investment trust, subject to approval?
Yeah, you can make a motion to enter into the CIT, subject to approval from underwriting on Dwayne's side.
All right, so yes, I make a motion that we enter the CIT, the collective investment trust, subject to approval.
Is there a motion on the floor? Is there a second?
I second.
Second by Mass. Is there any further discussion on the motion? Right, Travis has something to say. Now we'll call the question. All in favor, say aye. Aye. Opposed? Motion carries unanimously. Again, appreciate it. Thank you.
Thank you. And I'm going to let Larry know to turn it off so it doesn't keep rattling. And just word of the wise, Greg, Terrell, you got these little metal things right by your feet. They sound like gongs if you're not careful. There you go. Boom, there it is. But if you have a microphone, it really gets. Thank you. Appreciate it.
Thank you, Greg. Good afternoon, everyone. My name is Larry Donguila. I'm a portfolio manager at Sawgrass Asset Management. I'd like to thank you again for the opportunity to manage your fixed income portfolio. It's a true honor for us. As Greg mentioned, in terms of the performance, if we look at the performance for the whole fiscal year, we finished the year at 8.13%, ahead of the benchmark by about 115 basis points. And that brings the 3-year and 5-year right close to 5%, and the 3-year at 5.96%. So these are fairly strong numbers coming from the high quality strategy within the fixed income. Not only absolute speaking, but also relative to the benchmark. We're very proud of these numbers, and we were able to outperform the benchmark in this very volatile year. We all know what a crazy year this has been, and to have this type of a performance, we're very proud of these numbers. In terms of looking at what's driving this performance, if you turn with me on page 20, this is a measure of the pure credit risk in your portfolio. So it looks at the corporate bond exposure to your portfolio, and it measures that relative to the index in terms of dollars adjusted for sensitivity and quality. So basically, if you look at the ratio of anything below 100%, that means you're underweight credit risk. Anything above 100%, you're overweight risk. So if you look at the end of 2019, this is where, if you look, this is when we turned very cautious in corporate bonds, and we took that ratio down to 50% because at the time, corporate bonds were trading at near record heights, especially when you adjusted for the recent trends that companies have gradually levered their balance sheets by doing a lot of these levered buyback shares. Also extending the maturities, taking advantage of these very low long-term rates. So when you adjust for the lower quality fact and the longer maturity factor versus the historical averages, we made the decision back then that the corporate bonds were trading at record highs. So we turned very, very cautious. We went to 50% underweight. And sure enough, in the first quarter, we didn't forecast the pandemic, but we really benefited with your portfolio by being underweight risk as we saw that huge sell-off take place. We saw the S&P, it sold off 36% in only 23 business days, the fastest sell-off in history. Not only the stocks, but everything else kind of followed, right? The high yield spreads, corporate bonds, any financial asset really underperformed severely during that pandemic sell-off. And then we got the Fed that basically saved the day. They came in with that emergency rate cut over the weekend and initiated a huge buy program. And then later they also included the corporate bond purchase. So after they did that, we pivoted back to being overweight. So if you can look at that chart, we went from a 50% underweight to 120% overweight. And so we benefited on that snapback rally. So in the first quarter, we benefited by being underweight risk, credit risk. And in the second quarter, which was the opposite of first quarter in terms of the risk rally, we also benefited by having that beta, that corporate bond beta in your portfolio. So if I was to summarize what drove your performance, that was really it. The sector allocation, having the right decision on both those two quarters, were the single largest driver of your return. Now, looking at the current portfolio on page, well, let's look at some of the changes here on page 26. Looking at the quarterly changes here, you can see if you look at that top half, that credit risk ratio. So that's the same graph that I just kind of went over on a previous page. So you can see that as of the end of the third quarter, we have dialed that risk back down to neutral. That's because recently the market has pivoted so much to the other side that in many cases now we're seeing that a lot of these issuers are trading back to the pre-COVID levels. Even though there's still a lot of uncertainty, the economy still is lingering. We don't have a crystal clear path in terms of the unemployment trends and the overall economy and growth. So given this huge uncertain environment that we're still in, we're still looking at the spreads that are trading at really incredibly rich levels back to where we were, pre-pandemic levels. So with that kind of environment, we have dialed that risk back a little bit back to neutral. And if you look at that bottom half, the dollars that we took from the corporates, we've swapped them into the mortgage space. The idea there is that we're still trying to maximize the income for your portfolio by having that extra spread. But within mortgages, we're very mindful of the prepayment risk. Because with mortgages, you don't have credit risk because they're guaranteed by the government. Fannie Mae, Freddie Mac. These are all agency mortgages. But with mortgages, you get prepayment risk. And we've been basically very selective in that universe and trying to minimize the prepayment risk for your portfolio and still maximize the income. So that is the kind of the state, what we're thinking here. On page 27, you can look at some of the main characteristics. You're still looking at a 130 yield. So the rates are low. I mean, there's no doubt about it. And the outlook over the near term, we're not thinking that we're going to see any major changes to the rates. The Federal Reserve has already communicated to us that they want to keep the short-term rates to zero at least for another couple of years, given the severity of the hit that we got. So the whole action is expected to be towards that longer part of the curve, the longer dated rates. And that is more of a function of the expected inflationary pressures that we might see down the road. Near term, we think that rates will probably be anchored, but over the longer term horizon, given this huge monetary supply that has been already infused by the Fed and the expected recovery that we're going to get next year, the vaccines have already started to kick in. Over the longer run, we might see that bigger inflationary pressure kick into the market. So with that said, we've turned a little bit more cautious on the longer term interest rates. So there we're being a little bit more conservative, meaning having less interest rate risk exposure. And that is pretty much the only largest single risk that we see right now in the near future. But with that said, great return, great fiscal year in terms of the realized returns. And going forward, we should expect lower expected returns because of these rates where we are right now, but still be mindful of relative value. So with that, I'll conclude my brief presentation. I'll take any questions if you have any.
So when are you predicting that we'll see any type of fallback from the cost pressure as far as inflation is concerned?
I would say if the GDP, Morgan Stanley made an estimate that the GDP next year is expected to be at least 6%. I mean, these are crazy numbers.
What is it going to be?
Over 6%. And so that's a huge rebound from the big hit that we got this year. And if that momentum persists, and you're starting to see that in a lot of commodities, copper is in the near all-time high over the last 2 years. It's trading at the highs. All these big commodities are indicating that we might see that inflation down the road over the next couple of years. So that's something to be mindful of.
Any other questions? All right, you've got reports from Sawgrass. I'll entertain a motion to accept the report.
Make a motion to accept the report for Sawgrass.
Motion for the second. Any further discussion? All in favor, say aye. Aye. Motion carries unanimously. Moving on. Thank you.
Thank you.
Moving on, Capital City, Dwayne Madrid.
Good afternoon.
How are you?
Dwayne Madron, Capital City Trust Company. And I think Jill is putting up my report. There we go. Scroll down to the first page where it says policy review. There you go. So this is the third quarter report, and I want to go over the policy asset allocation versus the actual allocation. We currently have a big overweight of large U.S. equities, and that is because a lot of those companies are good growth companies. They're sustainable growth companies. Examples would be Apple, Amazon, Microsoft, Google, JP Morgan, Berkshire Hathaway, Visa, Walmart, Target. These are the types of companies I prefer to be in versus the other equity asset classes below that are neutral or underweight. So because of this large overweight, I'm underweight international, and I'm also underweight REITs, if you could scroll down a little bit. And I'm also underweight infrastructure, convertible bonds, and a little bit underweight fixed income. However, I'm approaching the policy cap for equities. So in the near future, maybe 2 or 3 weeks from now, I will be moving money to Sawgrass because equities keep going up as the economy recovers. Fortunately, the third quarter was a good quarter because investors regained confidence as the unemployment rate came down and the Fed continued to promise to backstop the economy, and the promise of the election being over also gave people some hope that there would be more certainty. The market does not like uncertainty. So it ran up really good between April and all the way into August, and then September and October, it hit a speed bump because it got a little expensive. And then November is a terrific month. So anyhow, we're overweight large US and underweight some of the other riskier asset classes. And any questions on that?
Wayne,
Yes.
hey, this is Burgess. Can you hear me all right?
Pardon?
Yeah. This is Burgess. Testing. Hey, this is Burgess. On the infrastructure program, do you think that those are very sort of COVID sensitive, those types of companies? When you're talking about the infrastructure? Hey, John, I know we didn't talk about this before the meeting, but maybe unfair to ask you, but, toll roads and airports and things like that that have been affected by the slowdown in world travel and so forth.
Yeah, that's a fair question. I would say some of them are and some of them aren't. I chose to underweight infrastructure simply because I prefer U.S. technology companies that have a fast rate of growth, and I see infrastructure as more yield and defensive oriented. And I wanted the beta, or rather, I wanted the portfolio to be tilted towards growth more than yield and defense in a recovering economy.
Fair enough. Thank you.
Yep. All right, Jill, if you could scroll down a little bit for me. We get to account performance. There we go. This is ending 9/30. The last 1 year, which is the fiscal year, the equity portion returned 10.49%. A good return considering COVID and the recession, where you see equities returning 10.3, keeping pace with a global equity benchmark, and taxable bonds returning 21.74. And that was a result of falling interest rates and the fact that your bonds on my side have an equity component to them. And so they tended to go up along with equities. And so that's a good policy decision, that your policy really helped you out in this case. And then you see real estate at -12. That's a result of a poor economy. And in bad economies, real estate doesn't normally do well because people can't pay their rents or they're not expanding and renting new spaces. But that's improving. So the last quarter, the fund returned 8%. Equities returned 8.3, beating a global equity benchmark. Bonds returned a whopping 10.4. And that's because your high yield and convertible bonds did well. And then real estate, as you see, is recovering and cash is earning almost zero. So I try not to keep much money in cash. So a good quarter and a good 1 year. There's not any questions. We can scroll down to October. Here you see one more month. Returns dropped back to 6.93 on the 1 year. That's because September and October. Now October was not a good month. That's where the market corrected itself because it became too expensive, and there was some nervousness about the COVID spreading in Europe, and also some nervousness about the election. So nevertheless, we got that back in November and more. So that's just showing you October. Year to date, the count's up 1.39. The November number, it's up a lot more than that. And Burgess may talk about that in a minute. If you can scroll down, please, Jill, to the next page. This is the asset allocation as of December 1st. There's 60.78% in equities, and those are pure equities. The high yield and convertibles are included in the fixed income in this particular page. And so you're in a moderate growth portfolio. It's not aggressive, but it's not balanced either. It's definitely a growth portfolio that's designed to do well in good economies and up markets. And that's a good thing because most economies are up. Now and then you get a bad one, but this portfolio has benefited from good stock markets and good economies in the past years. And Jill, if you scroll down, the rest of the report are simply the holdings, the bonds, which is the custodian's report, and then the mutual funds. And that really concludes my comments. Are there any questions?
Any questions? No questions.
Okay. Thank you.
I'll entertain a motion.
Make a motion to accept the report from.
I second.
There's a motion, a second on the floor. Is there any further discussion? Seeing none, all in favor say aye. Aye. Opposed, motion carries unanimously. Thank you very much, Mr. Madron. We're moving on to BCA and Burgess Chambers.
Hi, good afternoon. Should I use the mic okay. Okay. Thank you. I just thought I did this in the last meeting, I should do it for you too. If you go back to Sawgrass's materials, this is the book that they presented to you a few minutes ago, Sawgrass. You go to page 27. You'll note that the yield to maturity of the bond portfolio that they're managing quite well is 1.29%. And the reason why I point that out is that the equities that you have in the various funds that Dwayne is keeping an eye on and rebalancing periodically, some of those products are earning yields close to 2%. The reason why this is important to understand is this is probably the first time, this year is the first year in our lifetime where this has happened. This was not too uncommon back in the 1950s when early 1950s, post-World War II, when interest rates were still quite low and income, institutional earnings really came out of stocks that paid dividends and stocks that paid consistent dividends and companies that paid dividends where the trend was that year after year, the dividend payout ratios were going up every year. But then that all changed. And it changed probably back certainly it was quite different in the 70s when we had inflation that drove up interest rates. But the reason I point that out to you is that the bonds now, which are a significant part of the program at roughly 30% of your assets, are really a place to hold on to principal and protect the city's interest in this program. This is not going to be a high income generator until the yield curve goes back up. And you guys can weigh in any time on this. But in the meantime, we just have to ride this thing out and focus more on the growth side, grow the portfolio with the equities. So equities are the driver now, principal driver of performance going forward. Okay. Let's go to page, the very beginning of my remarks. I guess it's page 1 and it's titled, "Is it time for value stocks to move back into favor?" You can see at the first sentence in the third paragraph at the end there, the huge disparity between growth and value. Growth stocks, we're talking technology, have just gone way, way, way off the horizon compared to value stocks. A value stock would be like utility stock or a bank stock. A cyclical manufacturing stock. Those are value stocks. So the last time we saw this kind of crazy divergence where growth is just taken off and values just sort of falling way behind is in the late 90s. And in the late 90s, technology represented, I think, the top 10 stocks in the S&P 500. Let's say the top 10 stocks in the Russell 1000 Growth Index represented, I think it's 25% of the index. That sound about right? But as of 9/30 this year, the top 10 stocks, growth stocks in that index of 1,000 companies, I think represented 35%. So we have a very few companies, and you've heard of them all. If you watch TV, you've heard of them. If you go surfing looking for movies, you've heard of them. If you have a computer, you've heard of them. It's the same companies. Those handful of companies are driving this growth phenomenon. It's not the broad market. It's just a handful of stocks. So there's certainly risk in the market as we speak. I just wanted to point that out. And I know that Dwayne is also very much aware of that. But it appears that the rotation back towards value may actually have begun in September, because that gap, that 37 percentage point gap as of yesterday was right around 30. So it started to come, they're coming back together now. Okay, on the top of page, this book doesn't have page numbers. So they do this to me all the time. It says total fund investment summary, so it's about 4 or 5 pages in. Let's just go to the second bullet.
Page 4, there's a 4 on mine.
Well, I guess we're saving ink. But if you see the second bullet, the plan had a very good year, and your actuary is going to be happy with this, because you beat out the assumed rate of return, which I think is 7 3/4. Does that sound right?
I'm not sure.
Okay, we're going to find out. It's somewhere in that ballpark. You were at 8 for a long time. Starting to, I think it was last year that you decided to move it down to, does that sound right? To move it towards 7.5 in baby steps? So with a 9.7% net performance versus 10 gross, that shows an expense ratio of 0.3 or 30 basis points. So I should point that out. That's very competitive. You beat the model, and really the way Dwayne did it was he overweighted in equities. He did some pivoting earlier in the year, and you ranked in the top 17 percentile. And just to give you a sense of what that means, if you flip over to
Well, you flipped a lot
There
more than
you
you
go.
thought you did. 15. Here, trade books with me.
No, it's okay. I gotta make notes.
Okay.
They're very generous. But if you look at the 1 year and you look at the median, it's 7.5%. Wilshire which is another data collection service. We don't use them, we use another one. They reported 7.4% in the Wall Street Journal last week. So you finished out at, these rankings are done on a gross basis. You were at 10% gross. So there's the little dot there, you, and those 4 little boxes that are stacked, they're stacked up in that column there. You're in the top quartile, and that's the top quartile means you're in the top 25th percentile. So that's quite impressive. In fact, if you go back in time, you're in the top quartile for the last 5 years, for the 5-year average. Now, your actuary was looking for a return of somewhere in the 7 3/4 area. You can see that your 5-year average was 9% gross, and we know that the net is around 8.7%. So we can talk about the economy and all that stuff, but look, that's the mission. Can we hit the assumed rate of return that the actuary uses? It was accomplished here, and that's good. That was the mission. Okay. Back to the beginning. I guess it was page 4. Sorry about that. You can see that the 10-year average here was 7.9% gross, so it's about 7.6% net. The Florida retirement system, by comparison, they have the big FRS plan. In October, they lowered their assumed rate of return down to 7 from 7.2. So I suspect that your actuary, Patrick, is going to be advocating next year that you begin to lower your rate even faster back towards 7%. And we'll meet again in March. At the March meeting, are they going to be here in March?
Yeah.
Well, that should probably be on the agenda, the assumed rate of return. Have you gotten a letter from the state of Florida about your assumed rate of return?
Yeah.
Okay. What the state's doing is they're broadcasting out a standard letter to everybody. Whether you have great performance or average performance or low performance, urging everybody to go to 7%. Because that's what they just did. Are there any questions on the report? So the last thing I wanted to mention. What page is this? 14?
16.
16, 15, 14, 13, 12 maybe.
15. That one?
No. This is page 14. Oh, sorry, 13. 13. Is that gross? That's net. This is the top. No, it's this is the gross page.
Gross is 11.
All right. The big story, frankly, from an allocation standpoint, were the convertible bonds. And they earned 35.9% for the year. And that product, fiscal calendar year to date, as of 2 days ago, as of Friday, was up 45%. The convertible bonds are treated as equities. They're defined as equities in this investment policy. They're not defined as bonds. They sound like bonds because bonds are in the name. But they're bonds that have a equity option built into each bond. What all that means is where a typical bond is a contract between an issuer and a purchaser to collect a fixed amount of coupon every year during tours. A convertible bond performance is tied also to how well the common stock of the company does. So if the common stock of, let's say, Tesla, which is principal reason for this performance, which I believe represents almost 25% of this index now. It was around 16. But Tesla stock doubles in 4 months. That means that a sizable piece of this index is going to go up very quickly. And that's exactly, it's the Tesla effect. And that's why you got the 35%. So you didn't have to buy a Tesla. You got here anyway. And that's all I have. I think right now you're probably up about 8.5%, 9% for this quarter that we're in now, the new quarter. We've had an unbelievable jump in the market since October 1. I don't think anybody saw it coming. And I suspect that Dwayne is going to do a little bit of trimming back here. He mentioned that earlier. Trimming back some of the equities as they've gone up much faster than he probably anticipated as well. That's all I have.
Any questions? I have a motion.
Make a motion to accept the report from Davis.
And second.
Motion for the second, all in favor, say aye.
Aye.
Opposed, motion carries unanimously. Moving on to KKJL, Ms. Harvey.
Good afternoon, everybody. Can you all hear me?
Yes, ma'am.
Okay, wonderful. Really, I don't have much under the attorney's report today. I just wanted to advise everybody that, as I'm sure you know by now, the governor did not extend his order allowing our boards to meet virtually. So what our office is recommending is the board can meet in person, totally in person, if that's what it chooses, but it may also meet with a physical quorum present. In your case, 3 board members in a room in a public location like you are today. And then if there are any other trustees who would like to meet virtually, they may. And they may also, at that point, once there is a physical presence, a physical quorum present, then the other 2 trustees can can also vote on issues on the agenda and participate in the meeting, so long as they can be heard and they can hear the meeting as well. Are there any questions with that?
No, we didn't really want to save Mr. Cummings from having the ability to drive all the way to Palatka sometimes. I think he enjoys the highway time.
Very good. Very good. Thank you.
Thank you, definitely.
You're very welcome. We will, we continue to monitor what's going on. We're not anticipating anything allowing us to meet totally virtually again right now, but we will of course keep everybody informed as information is available to us. And I will work with the Sawgrass and Burgess on the agreement for the collective insurance trust that the board just agreed on today. If there's no questions, and that's the end of the attorney's report, I thank everybody for another wonderful year, and I hope everyone has a safe and happy holiday.
Okay, and Ms. Harvey, we also have Valerie Thomas, who's our local counsel on the line as well. So I guess between everyone, we'll get together and you guys kind of coordinate as well, so that we'll have all that stuff in place.
For Sawgrass?
See, we got our interim city attorneys on the phone, but she's on the call as well, listed just below you. And so that way, Valeria Thomas,
Gotcha.
So she's on as well. So she's on board. So we're
okay. Great.
I just wanted to give you an opportunity for you guys to make that intro.
I appreciate that. I will reach out to her and introduce myself, and I will get that information from Ms. Jill. Thank you.
Okay. All right. Thank you very much.
That. You're very welcome.
Next up we've got our expenditures under item 7. So
This is the expenditure report for the entire fiscal year.
And so, are there any questions as it relates to our expenditures for our fiscal year thus far? So you've got the turn. I'll entertain a motion to approve expenditures as written.
To make a motion to approve the expenditures as written. I second.
There's a motion on the floor in a second. Is there any further discussion? All in favor, say aye.
Aye.
Opposed? Motion carries unanimously. Thank you, Ms. Kaiser, on that. And moving forward, we'll keep moving the agenda with you for our next meeting. Our meeting schedule for 2021. It's on the board right now. And so we have our meeting scheduled for March 16th, June 15th, September 21st, and December 14th. So far, we just need a motion to approve the meeting schedule as presented by Ms. Kaiser.
I'll make a motion to approve the meeting schedule as presented. I second.
Motion on the floor in a second. All in favor, say aye.
Aye.
Opposed, motion carries unanimously. We're now open the floor for public comments under item 9. Anyone here wishing to speak during public comment, please do so by dialing, if you're on our YouTube lines, 329-0100, extension 220. If not, you can enter it within the chat itself. There's no one here publicly at this time. We're open the floor for public comment. Seeing no one here for public comment, we'll go ahead and close public comment at this time. Is there any other business before the agency? Mr. Williams's, Captain Williams's term is expiring, so can we kick him off? We got Captain Williams.
Yes, sir.
Are you willing to continue to serve, sir?
Yes, sir. Yes, sir.
So, Captain Williams is willing to continue, so we'll put him on the commission's docket for reappointment. So we'll have that in place, and just so everybody knows, we still have one vacancy left. And so if anyone has a recommendation, let's get it to Ms. Kaiser to see if we can get that vacancy filled, just in case Captain Williams decides that he doesn't want to show and we don't have enough people for a local forum. So, again, thank you to everyone, for this, for this calendar year, for the work that we've done. I think this is a pretty fruitful report for us overall. Wish everyone happy holidays, and again, just thanks to everyone, and especially to Ms. Kaiser for the work that you guys have done, council as well, and to Dwayne Madrid, who's somewhere hiding behind that camera. Again, just thank you all for all you've done for our pension plan, and we're just excited about the future, hoping that the market continues to perform favorably. Any closing comments from the board? Seeing none, I entertain a motion to adjourn.
Make a motion to adjourn.
You're adjourned by consent.
Thank you, everybody. Stay safe and happy holidays again.
Thank you.
Thank you. All right.
I'll be here.